If I told you there's a game where 90% of players lose money, would you play it? Well, millions of people do every single day. It's called day trading, and the reason they fail has nothing to do with markets and everything to do with their brain. Stay with me, because by the end of this video, you'll understand the psychological traps that destroy traders and how to avoid them. Before we dive in, let's get one thing straight. This isn't about whether day trading is good or bad. It's about understanding why intelligent, educated people consistently make the same catastrophic mistakes. We're going to break down 5 psychological biases that even professional traders struggle with. And here's the thing, once you see these patterns, you can't unsee them. Not just in trading, but in every financial decision you make. Let's start with the most dangerous bias of all, the Dunning-Kruger Effect. And if you've never heard of this, pay close attention, because this is probably affecting you right now. The Dunning-Kruger Effect is a cognitive bias where people with limited knowledge dramatically overestimate their abilities. In trading, this shows up in a predictable pattern. Here's how it works. A beginner makes a few lucky trades. Maybe they turn $500 into $1,000 in a week. Their brain floods with dopamine. They think, this is easy, I'm naturally good at this. But here's what they don't realize. They're not skilled, they're lucky. And luck, by definition, runs out. Studies show that beginners experience a confidence peak after just a few wins. This is called Mount Stupid on the Dunning-Kruger curve. They know just enough to be dangerous, but not enough to understand what they don't know. Professional traders? They've climbed down Mount Stupid into what's called the Valley of Despair. They've lost enough money to respect the market. They understand that every trade is probabilistic, not certain. The psychological trap is this: early success creates a false sense of mastery, and by the time reality hits, the beginner has already lost significant money trying to recreate that initial high. But even if you avoid overconfidence, there's another psychological trap waiting. And this one is even more insidious because it feels like you're being rational. It's called loss aversion. And Nobel Prize winning research shows that losses hurt psychologically about twice as much as equivalent gains feel good. Here's how this destroys traders. Imagine you buy a stock at $100. It drops to $90. Rationally, you should cut your loss and move on. But your brain doesn't work rationally. Your brain sees that $10 loss as a threat. Selling means admitting you were wrong. It means converting a paper loss into a real loss. So, what do most traders do? They hold, they wait, they pray it comes back. Meanwhile, a different stock you're watching goes from 100 to 110. You sell immediately to lock in profits. Why? Because your brain wants to avoid the pain of watching those gains disappear. This is loss aversion in action. You hold losers too long and sell winners too fast. It's the exact opposite of what successful trading requires. Professional traders have a mantra: cut your losses short, let your winners run. But loss aversion makes your brain want to do the opposite. And here's the brutal part. This bias is hardwired. It's an evolutionary survival mechanism. In nature, avoiding losses keeps you alive. In trading, it keeps you broke. Now let's talk about the bias that turns individual mistakes into market disasters. Herd mentality. You've heard the phrase, the crowd is always wrong. Well, psychology explains exactly why. Humans evolved to survive in groups. If everyone in your tribe is running from a predator, you run too. You don't stop to analyze whether it's really a threat. Social conformity keeps you safe. But in trading, social conformity gets you slaughtered. When everyone on social media is screaming, buy, 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 that's usually the top. When your co-worker, your neighbor, and your uncle are all talking about the same stock, it's already too late. The smart money bought months ago. They're selling to you. This is how bubbles form. Fear of missing out, FOMO, combines with herd mentality to create irrational buying. Everyone sees others making money and thinks, I need to get in before it's too late. The GameStop squeeze in 2021? Perfect example. Retail traders piled in at $50, $100, $200 per share because everyone was doing it. The stock eventually crashed. The herd got slaughtered. Here's the psychological principle. When trading feels exciting and everyone agrees with you, you're probably wrong. When it feels uncomfortable and lonely, you might be onto something. All right, we've covered overconfidence, loss aversion, and herd mentality. But there's one more bias that keeps traders stuck in a cycle of failure: the sunk cost fallacy. This is the psychological trap that whispers, you've already lost so much, you can't quit now. Here's how this plays out. A trader loses $5,000 on a stock. Instead of cutting their losses, they think, I've already lost $5,000. If I add more money and it recovers, I'll break even. So they add another $5,000. The stock keeps dropping. Now they're down $10,000. The psychological pain is unbearable. They add even more, convinced it has to bounce back. This is the sunk cost fallacy. You make decisions based on money you've already lost instead of evaluating whether the trade still makes sense right now. Casinos love this bias. Gamblers think, I've already lost $500 tonight. I can't leave until I win it back. So they lose another $500. The money already gone influences future decisions. Rational thinking says ignore what you've already lost. It's gone. Ask yourself, if I had cash right now, would I buy this stock at this price? If the answer is no, then you shouldn't be holding it either. But your brain doesn't want to accept the loss. It wants to believe you can fix past mistakes. And that's how small losses become catastrophic ones. And finally, the bias that makes traders see patterns that don't exist. Confirmation bias. Your brain's favorite trick, finding exactly what you're looking for, even when it's not there. Confirmation bias is the tendency to search for, interpret, and remember information that confirms what you already believe. Here's how it destroys traders. You buy a stock because you think it's going up. Then you obsessively read articles that support your thesis. When negative news comes out, you dismiss it as fake news or market manipulation. When positive news comes out, you think, see, I knew I was right. Your brain isn't trying to find the truth. It's trying to protect your ego from being wrong. Social media makes this worse. Algorithms show you content similar to what you already engage with. If you're bullish on a stock, your feed fills with bullish posts. You're in an echo chamber and everyone agrees with you. It feels like confirmation, but it's just bias. Professional traders actively seek out opposing views. They ask, what would make me wrong? They read bearish analyses even when they're bullish. Why? Because the goal isn't to be right. The goal is to make money. And making money requires seeing reality, not just seeing what you want to see. Amateur traders surround themselves with yes men. Professionals surround themselves with people who challenge their assumptions. So here's the brutal truth that nobody wants to hear. The reason 90% of day traders lose money isn't because they lack information. It's not because they don't have the right software or the best indicators. It's because trading is psychological warfare against your own brain. Every bias we've covered, Dunning-Kruger, loss aversion, herd mentality, sunk cost fallacy, confirmation bias, these exist to protect you in normal life. They helped your ancestors survive, but markets aren't normal life. Markets reward people who think probabilistically, act counterintuitively, and control their emotions. Your brain wasn't designed for this. The professionals who survive, they're not smarter, they're more self-aware. They've lost enough money to respect these biases. They have systems, rules, and discipline to override their instincts. So what do you do with this information? First, if you're thinking about day trading, understand that you're not just competing against algorithms and institutions. You're competing against your own psychology. And that's a harder opponent than any hedge fund. Second, if you do trade, implement systems that remove emotion. Set stop losses before you enter trades. Journal every decision. Review your mistakes weekly. The goal is to catch these biases before they destroy your account. Third, consider this. Maybe the real edge isn't finding the next big stock. Maybe it's finding the discipline to sit on your hands when your brain is screaming at you to act. Warren Buffett once said, "The stock market is a device for transferring money from the impatient to the patient." He's not talking about strategy. He's talking about psychology. The traders who win aren't the ones with the best predictions. They're the ones who understand their own minds well enough to not sabotage themselves. And that's the real lesson here. Whether you trade or not, these biases affect every financial decision you make. Buying a house, choosing a career, investing for retirement. Once you see these patterns, you can start to break free from them. If this video changed how you think about trading, or really any decision making, do me a favor and hit that subscribe button. I break down the psychology behind money, investing and success every single week. Drop a comment and let me know. Which of these biases do you struggle with most? Thanks for watching. I'll see you in the next one.